CMPRadio.net, it's the station. Listen, let's cultivate together. Let's grow something spectacular together. Send me your info to info@cmpradio.net. We're looking for content creators, videographers, everything, man. Let's grow something special right here. Homegrown. Chester, Pennsylvania. Let's go. Let's get it down, man. It's your boy, Uncle Pete, reminding you, man. CMPRadio.net. Cultivating mature positivity.
Hi, I'm Ariel Marie Bryce Rankin, CEO of CMPRadio.net and Cultivating Mature Positivity. CMP is looking to expand our family. Could that be you? We're looking for dedicated individuals with interest in hosting, co-hosting, conducting interviews, production assistance, and even participating in our up-and-coming drama series. Don't sit on the couch. Contact us at info@cmpradio.net or our Facebook page at cmpradio.net. Cultivate Mature Positivity is the station.
All my life, been grinding all my life. Sacrifice, hustle, pay the price. Want a slice, got to roll the dice. That's why all my life, I've been grinding all my life. All my life, been grinding all my life. Sacrifice, hustle, pay the price. Want a slice, got to roll the dice. That's why all my life, I've been grinding all my life. I'm married to this guy, that's who I made my wife. Said I died alone, I told that bitch she probably right. One thing that's for sure, not a stranger to the got a safe that's full of fragments and a shoulder full of stripes. Don't know a nigga like myself. I say self-made, nigga. County jail fade. You can pull my file yourself.
Hey, what's going on, y'all? It's your boy CPT_Young Inspires. Big C, Big P, Big T, always ready with that financial literacy. Holla at your boy. And here we go with Financial Podcast episode number 2, Credit Literacy. Quick disclaimer, any advice given on this show is purely a suggestion. It is not for you to go out here and take my word of advice, because I am not a certified credit advisor, but I am dropping financial bombs, and I hope that you can take this on your financial journey and improve your quality of life with all the tips and tricks that we discussed during this podcast. Our first co-host that I want to introduce today, she's currently a teacher. She worked with the school district. She worked with the Chester's political administration in the financial sector. Right now, she teaches financial literacy to high school students. I knew her as a kid, and she was one of the toughest basketball players to come out of the city of Chester. Please, everybody, welcome Miss Mosley.
How you doing? Thank you.
Talk about introductions, man, because I remember, listen, I used to go to all the games. You know, I used to be at all the games. I had no choice. My sister was on the team with you, and between you, her, who was it? Christian Maya, and I can't remember the one girl name, but y'all were pretty much on the same team from like middle school.
Ashley, Alicia, yeah, we all played on the same team since we were like maybe 9 under Coach Mike.
Yep.
Just about.
But tell us something about yourself.
So like you mentioned, I'm teaching over at Chester Charter Scholars Academy. Teach entrepreneurship to our senior students, which is a hands-on entrepreneurship class. The students actually have the opportunity to operate their own business. This year, because we were virtual, the students actually designed their own clothing brand. So we have 2 clothing brands, Chester Made Fit and Fall Society, where the kids are actually designing, everything about a business. Each student actually has their own job. So we have, fashion designers, graphic designers, accountants, managers, delivery, marketing, sales directors, every type of position that kind of can be within a company. So the students actually, learn the ins and outs of a business. And then, like I said, they also we just started to kind of like piecing together their business plan. And then I also teach personal finance. That's an elective course offered over there. The different type of things we talk about in that class are everything like we're going to talk about today pertaining to credit, what credit is, how to calculate APR, the interest, how to determine your credit score, how to read a credit report, credit card statement. We also talk about things like the taxes that are deducted from your paycheck, the difference between, financial needs and wants, different type of expenses, how to budget. And then we briefly kind of talk about investing a little bit. So those are just some of the topics and the difference between renting and buying. So those are just some of the topics we talk about in that personal finance course. Also, a licensed financial planner through Primerica. And then I also have a coach at CCSA as well, the varsity coach. And then I have my own basketball skill training and development company with my brother, Quest to be Elite, and my own AAU program, which is Team Elite.
So at what point do you actually sleep?
Believe it or not, I go to bed about 9:30, 10 o'clock. One thing about I'm very meticulous. So I definitely set my schedule to where everything kind of runs really smoothly. So I'm fortunate enough to have pretty good time management skills where I can kind of get things I need done and still get my 8 hours. So fortunate there.
All right, y'all. Well, please welcome Miss Mosley, and next we'll be welcoming our guest speaker, Mr. Bruce Collins. Mr. Bruce Collins is a credit specialist. He works, or I believe he owns, Broadway Credit Solutions. Please welcome Mr. Bruce Collins.
Hey guys, thanks Nas. Thanks for having me on here today. Like you said, my name is Bruce Collins. I was born and raised in Chester, a product of Chester Upland School District. I graduated with a marketing degree from Temple. I obtained my master's in finance from St. Joe's. Shortly after graduating, I went straight into the financial industry with PNC. I worked as an underwriter for 8 years, a small business. I worked with the likes of TD Bank. I'm currently the commercial credit manager for one of the largest credit unions in Pennsylvania, where I decision deals as low as 50,000 upwards to 50 million. As Nas mentioned, I'm the owner of Broadway Credit Solutions. About 2 months ago, I started this company. Basically, I have an abundance of knowledge regarding credit and things of that nature that I take for granted. So I wanted to offer a low price service just to educate my people. We all know credit repair services run upwards to hundreds and hundreds of dollars. So the fact that I'm blessed enough to not really want financially, I'm able to lower my prices to better suit the community needs, because I really feel like how can we hurt them when they trying to build their life back up. So I don't want to hurt you trying to build yourself, So yeah, I just have a wealth of credit knowledge over 15 years, and I'm here to share that today.
Awesome. And I appreciate the fact that everybody on this podcast right now are from the city of Chester. And as you can see, I have pictures populating in the background. I guess because of the screen, it's a little blurry, but I wanted people to see the beauty of Chester. So if you could look in the background, every picture that pops up is a different shot of Chester. And believe it or not, it's the beautiful pictures that people don't actually take the time and recognize about the city. So if you can see some of the shots, please keep looking while we're on the podcast. But to kick this thing off, the elephant in the room, we have to discuss this. And I want to hear answers from both of y'all. What is credit? How do you define it in your own words? Bruce, kick it off.
In my own words, I define credit as a numbers game. I believe credit can, if you understand credit, you can know how to use it to benefit you in every situation. Most people look for the high score and keeping the utilization down, but it's times where you can play with that, depending on what the circumstances in your life are. So I define credit basically as a numbers game, and once you understand it, you can greatly use it to your benefit.
Okay. What about you, Miss Mosley?
So the fortunate thing about teaching high school students is, especially when it comes to finance, you have to learn how to take very complicated topics and definitions and break them down to where kids can understand. So that actual definition I give my students is that credit is borrowed money that is based on your trustworthiness. try to make it real simple for them. It's not actual cash, it's borrowed money. So that's the first part I really want them to understand. It's a front, it's a loan, and it's something that's established based on if that lender trusts you or not. So that's kind of just a simple way. And one of the examples of how credit works, I usually give my students, we have demerit to them. It's based off like scholarly conduct. Their scholarly conduct score is kind of based off of your behavior in school. So I usually give that example to my students. It works exactly like your scholarly conduct score, right? So if you do everything you're supposed to do in school, what happens? They're like, oh, my scholarly conduct score stays high, or it can go up. And what are the rewards of a high scholarly conduct score? It's like, oh, we can do dress down days. We can do, we can go to the parties or the events that the school's having, right? So if you don't do what you're supposed to do in school, right? Like if you're getting demerit, what happens? Well, my score goes down. And then how does that impact you? Well, then I have to do detention. I can't do all the fun stuff the school's doing. Right. So that's like an example I give the students to make it relatable to something they can really understand. But it's like he said, it's a numbers game that you got to know how to play, know how to build it, know how to recover it, know what not to do, for your score to decrease. But that's the biggest component I want them to always remember, that credit is borrowed money.
Excellent. I think people sometimes forget that credit is borrowed money. Too often you hear people say like, "Hey, I'm paying the minimums," but you're paying on borrowed money. So the goal is to make that thing say zero. You already started off in the wrong way to start with the credit. So I think that's a great analysis. I love both of your answers. So moving forward, let's talk about the credit ranges. Not too many people know where their credit score falls, what the credit score is, and then what that perception is to any lender. So, can any of you expound on credit ranges?
So there's about 5 different categories you can have. Of course, starting with exceptional, which is, I believe, 800 and up. Then you have, which is basically with exceptional, you kind of get what you want. They talk to you different, when you walk in. Would you like water? You like some chips? Listen, I'm not even going to lie. As an African American, I know sometimes my name is a little hard to pronounce. When you have good credit, you make sure they pronounce your name right. It's a different conversation. Then you have very good credit, which more than likely you'll be approved for the most things you want. You probably won't really have any issues. You have fair credit or good credit, which is kind of around like the 730, a range. More than likely, you'll also kind of still be approved. You may have a few hiccups depending on what you're applying for and how much. And then I believe the second to lowest is fair. Might have some difficulties being approved. And then you have bad credit, which is just going to keep it moving, mind your business. And I actually want to talk about that one before Bruce go ahead and does his thing. Because one of the things that really, I would say, probably grinds my gears are certain commercials you hear on certain type of channels. You don't really hear them on Q102. You don't really hear them on 96.5. You hear them on Power 99. Good credit, bad credit, no problem. That is a problem. That whole, it's a crime to pay more than a dime. Yeah. It's a problem. You hear those type of commercials on certain type of stations. And one thing I even say to my students, there is a reason you would be denied for a loan. That's not just random. There is a legitimate reason you don't qualify. And it could be a number of factors. Not having credit, is bad credit because there's not enough established history for a lender to make an informed decision. If you try to have to put stuff in other people's name, again, that's something that there's a reason you didn't qualify for that. So good credit, bad credit, no problem. When you hear those commercials, please stay away. If you don't get anything from this conversation, when you hear those commercials, good credit, bad credit, no problem. It is a problem. Stay away because your interest rate's probably going to be about 30% on a used vehicle. Don't do it. But those are the 5 ranges.
Okay.
So what I asked, so she basically summed up the ranges. So I'll look at the ranges from a lender's perspective. If I was underwriting a deal, when an underwriter gets a deal, the first thing we're looking for is a decline. Why go through all the hassle of underwriting, writing all this if we know we're not going to do the loan. So first things first, if I'm looking at a 600, 630 less, it's probably going to be a decline from the start. I'm not even going to go through the motions. I'm not going to keep the customer waiting. I'm not going to keep the lender waiting. We're just going to decline that off the top. So unless you walk into the door in the 700 range, you don't really have much of a chance. And like Duana said, I done seen people with car rates as high as 15, 16%. I'm walking around right now about a 2.7. And that's just the difference between your bargaining power when you walk in the door, like she said. The biggest thing I want people to take away is that we don't have to be happy just to get an approval. We want to dictate the terms, the rate, the fees. We want to go in and say, this bank is offering me this rate, this fees. What can you do to match that? How can you beat that? Why should I take your money? If I don't take your money, you don't make money. So you need me more than I need you. We need each other. But if my credit through the roof, every bank want me. Everybody's approving me. So I get to dictate the terms. And that's how I come in. When I come in the door, I talk like that. When they know you confident and you got that credit behind you, there's nothing they can say. And the most thing I want to, I think the biggest takeaway is when it comes down to loans and things of that nature, you can have the best credit in the world too, but income is just as important. If you have an 800 credit score, but you can't afford the loan that you're asking for financially, then it really doesn't matter. So I want to say just as important as credit, you got to have an income to match too, but it definitely starts with that credit, just being able to walk in the door.
And just to finish off what he just said, because Nasir, you and I kind of had a conversation last week about how the type of income, the amount of income that they use to qualify for loans. And that was something that I thought was very important to mention. Lenders use your gross pay. And the reason that's important for people to really understand is gross pay, of course, is not the amount of, sorry, I have earphones on. Can you guys hear me?
Yes, I can.
Okay. Gross income is not the amount of money you're bringing home. And the reason that's really important for people to know when we talk about, especially when a big purchase is usually a house, understanding like you really have to base your bills off the money you're bringing home and not what you're making, because again, they're going to approve that mortgage or that loan based off the $50,000 you make. In reality, when we take away taxes and all your other expenses, you're probably bringing home anywhere between 30 and 35. That's $1,000 a month we're talking. That's a huge difference. So when we talk about, like you just mentioned, the importance of not only just having a good credit score, but the income to match with the loans you're trying to receive, you really have to understand it's based off your net income. So that is important for me. I think it's very important for people to always calculate those loan amounts using their net income and not their gross, because that's way sometimes we kind of get behind the ball at times, because you may have qualified for that loan, but can you actually afford it? Those are two different things.
And I also want to add that if when a bank is looking at a loan, they're reducing your income anyway as for living expenses. You gotta get gas, you need to get food. They don't know how much you're spending on living, so they got to take a percentage away just to assume. So if you make a good amount of money off top, they taking away 15, 20, 25%, or a minimum of whatever it is for that year. So if you come into the table with 50,000, you might already be down to 35,000 just for them to put their conservatism on, into play.
Excellent. Well, you pretty much covered the capital portion of trying to obtain credit and going to lenders. So at this point, I kind of want to focus on the different credit factors that these lending companies are going to look at. We know one is total accounts, right? So how many accounts do you have with a credit line? And that typically runs you about 10% of your credit score. You got length of credit, which is about another 15%. And you discussed that already. And basically that means how long have you had these open lines of credit? You have your inquiries. And that's basically how many times have you done a hard pull? And I'll let you guys elaborate on hard pull later. You have revolving utilization, which is about 30%. And then you have missed payments, which equal another 35%, getting you up to a full 100% of your credit percentage. So let's start with total accounts. Can you discuss the difference between revolving credit and installment credit?
Sure. You want to take that, Bruce?
I'll take it. Well, revolving credit is like, lines of credit, your credit cards. It's credits you can use over and over again. You pay it up, go down, you pay it off, you can use it again. Installment loans is your car loans, your mortgages. These are loans that have, you just paying the balance down. So that's basically the difference between revolving and installment loans.
And when we talk about installment loans, I think it's very fascinating. A lot of people, when we talk about installment loans, they think they have to pay just what their payment is for that month, not necessarily trying to pay down the principal, but they're only worried about that one number that they get monthly. Talk about how thinking you only have to pay that one amount each month can affect your overall credit worthiness at a later date.
So the first thing, I think the educational piece in what you just said is understanding the payment is equally principal and interest. Those two things are combined. Especially when you first start a loan, I need you to understand these lenders are in the business to make money. So when you first start a loan, they're collecting theirs up front. They're getting theirs first. So you have to understand that. That's why if you get a mortgage, right, you'll have your mortgage for about 2-3 years, and you're like, why is my principal still the same? Because they're putting about $25 towards your principal, and they're collecting theirs off the top. So that's the first thing you have to understand. That payment, whatever payment that is established for you in installment, is principal and interest. That's the money going towards your loan and the money that they're making. At the beginning of loans, majority of your payment is going towards them. So, and you have to understand, based on, especially revolving credit, your payments are based off what you owe. And like you mentioned, installment credit is a determined amount up front. They're factoring in their money, what you're paying them, but revolving credit is based on what you owe. So there's a vested interest, and that's the one thing people really have to understand. Lenders are in the habit of making money. They're in the business of making money. So I'm lending money to you, and I'm going to recommend you only pay this minimum, right? Because that means it's going to take you forever to pay this loan off. If you ever really looked at a credit card statement, right? The amount of money you owe is really, really big. And then that little paragraph when they legally have to tell you, hey, if you pay the minimum, it's going to take you all this time to pay off, and you're going to end up paying us this much back. That's really, really small, because they don't really want you to know that, right? Keep paying the minimum because they make more money. So you have to understand the difference between principal and interest. Principal is what you owe, and interest is what they're making. So knowing that, like I said, us paying the minimums, which again, this goes back to being qualified and being able to afford a loan, right? You definitely want to, with credit cards, you want to try to pay them off every month, but you definitely want to pay more than the minimum, because anything above what your minimum payment is goes towards your principal, and that helps you. So you don't really want to ever get into a situation where you're only paying the minimum payment, because again, that's helping them, and that's just taking you a longer time to pay those loans off.
I love the way you just summed that up. But I want to take it a step further and expound a little deeper on revolving credit manipulation. And there's the old myths out there where they say, or I won't even say myths. It's a good idea. It's a good strategy, but it's not the only strategy. And one of those is, keep your utilization under 30%, and pay the credit card off every month. Or the myth I hate the most is everybody always says, yeah, soon as I swipe that card, I go straight in my app and pay it right off. Don't get me wrong. While that is a means of keeping your utilization down, people fail to realize that if you swipe that card and pay it off immediately, that report never gets sent to the major credit reporting agencies. So it looks like you're not really using the card. So how can that affect your overall credit score when we talk about your length of credit and your revolving utilization?
So the important part with that, and of course I'll let Bruce jump in. The important part with that is understanding, like you mentioned, the percentages. The first most important thing is payment history. So you want to pay them all on time. The second most important thing is credit utilization, and then length of credit. Those are the three most in that order. when you're talking about using credit, for one, the credit utilization used to be 50%. It used to be 50%. Government just lowered it to 30. Didn't really say anything, right? But at the same time, if from a lender, if you're not using the card, like you're saying, if you're using it and then paying it, and we don't see that transaction, they will close your account out based off of lack of use. Here's how that can hurt your credit score. Your credit, like I said, we know the second most important thing about your credit score is credit utilization. So basically, all credit utilization is the amount of money you're using divided by the total amount you have, right? So just to give, if I have $1,000 limit and I'm using $100, 100 divided by 1,000 is 10%. That's how you figure out your credit utilization rate. So again, your credit score factors in all the debt you have, and we divide that by how much you have available. So if you don't use a credit card and they close it, now you have less available. That's going to affect that percentage we're talking about. I've had clients where, hey, depending on certain things, ask for a credit increase. Well, I'm not really using it. Ask for a credit increase, I guarantee your score will go up, right? Because now when you get a credit increase, your availability is more, which now change that percentage in your favor. Your credit utilization can go down just because you actually increased the credit limit on another card. So like Bruce said at the beginning, you really just it's a numbers game. You really just got to know how to play the game that's already established, that's already written. You just got to know the rules. So like I said, that's the biggest thing, is understanding what impacts your credit score the most. The one thing I will say, if you are fortunate enough to do this, anything that's on your credit report needs to be auto pay. It needs to come directly out your bank account. There's no question that that's something you don't mess around with your credits. One missed payment can drastically lower your credit score. Even if it's a mistake, it's hard to get it reversed, right? So if you are fortunate, anything that's on your credit needs to be auto debited out your bank account, no questions asked. So I don't even have to worry about that.
That is game changing. And I think a lot of people don't know to just go ahead. You already know that the money is going to come out, or at least you have to pay it. So if you put it on auto pay, at least you're not missing the payment. I actually got a funny story for that. I try to put a lot of stuff on my credit card, right? So I put a lot of stuff on my credit card and I put all of them in auto pay. And I was doing this for years, right? But what I didn't realize was my credit card was about to expire, and then it eventually expired, and I had all of them on auto pay. So that month, my credit score dropped like 20 points. And I was like, what the heck just happened? So I'm calling around. I'm like, hey, well, I know I paid. I'm on auto pay. And they're like, no, you didn't pay. Finally, I called the card company and found out that they sent me out an updated card. But obviously, I have to go back to all of the companies and update the credit information. So then I had to go back to the credit reporting agencies, obviously with the IRS, and fight and say, hey, I didn't miss any payments. It was a mistake. And then my score eventually went back up.
But even that's based off, like I said, the definition I gave on trustworthiness. Now they're going to look at your credit and say, oh, here's a guy who's never missed a payment. We're willing to work with him. That really might have been a mistake. But if you're a person that has an established history of missing payments, I'm not trying to hear that, because you're probably lying. But again, it's based off your credit. Like, you can really tell a lot about a person, their habits, their spending, based off their credit score, whether people like to believe it or not. But again, when we go back to qualifying and being able to afford a loan, a lot of people don't like to put on auto pay for bills, right? Because we know we're probably going to rob Peter to pay Paul, right? We want to do something. I'm not trying to pay that. I'm trying to go do this real quick, even though I know I have to pay that. So again, that goes back to when we first had to talk about accountability and budgeting and different things like that.
So, Bruce, I got a question for you. One, what are the 3 different reporting agencies for our credit? And why does our credit score vary across the 3 different agencies?
A good question. So the 3 agencies are Equifax, Experian, and TransUnion. And the reason why the scores may differ because each agency may pick up different trade lines. Every trade line isn't reported to every agency. So Experian may be reporting different activity than TransUnion, and then some might be reported different than Equifax. So you may see a difference in the scores. Like when I'm looking at credit, you may see inquiries on one that you don't see on the other, or you may see derogatories or late payments on one that's not picking up on the other. And it's just that they're not reporting to those bureaus. So basically, each bureau, if they don't show the same information, you'll see a difference in scores.
Okay. Okay. In a second, we're going to take a question from the audience and see what they're thinking. But before we get to the question, when we talk about the different agencies and we talk about those different credit scores, how does it look to a lender if one agency is reporting, let's say, a 760 and another agency is reporting a 720? What goes through the lender's mind when they see such a varying discrepancy or just a gap in your overall credit score?
So like Bruce just said, every company does not report to the same credit bureaus. So, and there's also different scoring models that exist out here. So you have to understand, based off if it's Experian or TransUnion, the score might just be different because of the scoring model that they're using. You know what I'm saying? One may be using Vantage Score or whatever. So that's going to affect the score. And like Bruce just said, because everyone doesn't report to the same agencies, legally they don't have to, that's going to determine your score too. But the reality is your score should not be so far apart. Like it shouldn't be something like 50 or 100 points. Like usually your scores are well within the same realm. One might be a 712, one might be a 720. Like they're not that far apart. Because for the most part, the big stuff, your big stuff are usually reported on everyone. Like small things, if you have like a personal line of credit through a credit union, or if you have like a small credit card, like that may not be on there, but the big stuff usually is. So your credit scores wouldn't be too far apart across the ranges, but that's also why, even from a mortgage standpoint, they take the middle score. Like they collect all three of your credit scores when you're applying for a loan, and they take the middle score because this is considered the median. So like I said, they do factor that in, but it wouldn't vary. Your score shouldn't vary that far to the point where it's like an issue.
And if it do vary, you will probably be able to look at the credit report and see exactly why. Sometimes you might have a late payment that's back current, and one agency is reporting it current, and the other agency is still reporting it late. So you might see a big jump on one and not on the other one yet. Things of that nature.
So pretty much, folks, if you are not actively looking at your credit report or pulling that information from any one of your credit cards, because a lot of credit cards offer the option for you to go in and look at your credit score and what's affecting it. I would highly, highly, highly suggest that you go out and you pull your credit report and understand what's affecting your credit. I recently pulled my own, and one of the agencies, said I had X amount of open lines of credit, and then another one reported 5 less. So then obviously I'm like, all right, let me go back, see how many open lines of credit I actually have, both revolving and installment, and then rectify the difference with whoever has the false reporting. And it worked, right? So after I did that, my credit score with that agency went up. So that's just something to consider. When we talk about inquiries, though, before we pull a question from the audience, when we talk about inquiries, we know there's a such thing as a hard pull and a soft pull. And we typically do pulls when we're shopping, when we're in the market for shopping. Can either one of you expound on the difference between a hard pull and a soft pull, and just the overall effect that could or could not have on your credit?
Well, a soft pull is pretty much basically when you pull your own credit, or you might receive like a pre-approval in the mail or something like that. And that's basically a soft pull. A hard pull is when you're actually applying for credit, when you're applying for a mortgage, an auto loan, a credit card, and that's called a hard inquiry. Soft pulls don't affect your credit score, but hard inquiries, they will slightly bring your credit score down. In the lending world, we don't like to see a lot of recent inquiries. Sometimes they call it pyramiding debt. So a lot of recent inquiries is a decline reason.
Like Bruce said, just to piggyback, the only time where a lot of pulls is acceptable is if you're applying for a mortgage, mainly because they're expecting you to shop around to different lenders to get the best interest rate. But even that, it's within a certain time frame. And correct me if I'm wrong, Bruce. I think it's 30 or 60 days. It's a certain number.
Yeah, you'll see all around that date. All the inquiries would be all in that same
that's
date.
like really the only time they don't knock you. But like Bruce said, again, you could tell a lot about a person from their credit report. You know, if I see you're applying for a bunch of loans at the same time from a lender, I'm probably thinking this person is probably strapped for cash. They don't really have money available. They're in a financial bind that they're desperate to just get money from anybody. This person is a risk. I won't lend to them. So like Bruce said, a lot of inquiries can just look bad. And a lender, like that's all it is. It's a numbers game, like you said at the beginning. Do I believe this person is going to pay me back or not? Like that's just like if you had a sibling that asked you for $10 every week and they paid you back, cool. Your sibling don't pay you back a couple times, they ask you again, you're like, hell no. Like based off habits, based off a track record. So again, it's a numbers game. Do I believe this person is going to pay me back or not? And they judge you based off your score, right? Like, oh, this person more than likely is going to pay me back. So when a lot of inquiries, it's recommended to try to have less than 2 every 2 years. The most hard inquiries you should have are 2 within a 2-year period. And you should not apply for credit if you don't need it.
Yeah, that's why it's important to know your scores and your credit worthiness, because when you're applying, you know you're going to get it. So you want to make the right decision the first time. You want to know when you walk in the building that you're probably going to get approved, and you want to just go in one time, you know, and incur one inquiry. You don't want to have to shop around, and that may hurt you down the line just trying to make another move.
And Bruce, he's a credit expert here. I would recommend using Credit Karma just because, like, usually the stuff that's reported on there is accurate. I would not walk around feeling extremely confident based off the score, because a lot of the times their score is off. I've seen people say, "Oh, Credit Karma told me I have a 750." You go to the bank, it's not a 750. But as far as usually the things that are reported on Credit Karma are very accurate. So and it's a free app. So if you just want to be able to keep, like, to me, I feel like as an adult, you should check your credit as much, especially because of the day and age we're in. People are sneaky, you know, people like to, you know, steal identity. So I think checking your credit as much as possible is important. So if you just need that, you know, weekly check or whatever, so you can know, make sure nothing happened, I would say Credit Karma. But also, I believe the U.S. government allows you to get one free credit report from all 3 bureaus for free every year.
I want to add one
website. I don't know the exact website.
I'm not sure. You can just Google. But I want to add one thing about the security and fraud that you mentioned. So that's one good benefit about having good credit and credit cards. With all the security fraud going on and all the point systems with the credit cards, you know, it's good to use a credit card, you know, as long as you don't abuse it, because you're limiting the fraud against your personal account, you know, and you're building points and rewards and things of that nature. So it's definitely good benefits to using credit cards, especially in times like this when there's so much fraud out there. You can play with somebody else's money. Why put your money on the line? And then you can fight with them and get it back, you know, instead of having your actual bank account tied up in it.
Yeah, that's a great point, especially when you're traveling outside the country. I would definitely always recommend that. Or even when you're just traveling, period. I know, like, most banks, you can actually set up an alert like, hey, I'm traveling here for this much time, I'm going to be there. So if your card is used in another state or another country, there's no surprise. But like you said, especially when you're traveling, because if someone steals your bank account, like, that's why one of the biggest issues with Cash App. Like, right, I have a Cash App. I don't attach my bank account, because somebody hacks that's your actual money. Then there's a whole process they got to go through to verify. It could take you months to get your money back, as opposed to with a credit card. I didn't do that, right? Y'all need to look into that. They can reverse that within days. So I definitely agree. Like, when you're traveling, I would recommend using a credit card for those purposes, because it's not your actual money that you worked every day for.
So for the audience out there, if you didn't catch those gems, a hard pull is the only one that affects your credit. If you do multiple pulls within a 30-day span, it's generally reported to the credit bureaus as one pull after they consolidate all the pulls that you've done, because they know you're shopping. There was one question I seen in the audience from Tamara Payton. It says, how often should you pull your credit? A general rule of thumb for me is I typically only do the full credit report pull and look at the entire report about once or twice a year, like a 6 months difference. But one thing I do and I'll have you guys chime in on this in a second. But one thing I do between my various credit cards, they all have my credit report on there, and it's free to me. I can just go in and pull. So generally what I'll do is I'll look at one, look at the other, and find my happy ground somewhere in the middle. And that just gives me a general idea of what my credit score is looking like, especially since I know I'm not going out here and applying for any major credit cards, doing any new car loans or mortgages. So generally it'll stay around the same. One thing I do want to mention before we transition or you guys chime in is another tip. And again, I'm not out here trying to give you financial advice, more or less suggestions. And, you know, each one of them hit on it so far with total accounts, length of credit, and revolving utilization. But when we talk about keeping your utilization at 30% and under, that's stabilizing your credit. So that's letting the lenders know that, you know, through this length of time that this person had this account established, they weren't out here going out here and buying things that they know they couldn't afford, thus taking them a very long time to pay it off. And they bust that 30% utilization for a lengthy amount of time. But I want to debunk the myth. You can go over 30%. And to be honest, credit lenders look when you go over that 30% if you can afford it. That's the kicker. If you can afford it. So please don't take this advice, think, oh, I can go out here, swipe, be over 30, and then pay it off when I get to it. That's not what I'm about to tell you. But one of the tips that I've learned from a mentor, and it actually works, right, is it's all about your utilization. It's like a roller coaster, right? You don't want to do this for a long time, but you can do it for short times, and you will see your credit score go up. I will advise that it's going to have a dip, and then it's going to go up 2 or 3 points higher than where it was to start. And what that is if you swipe your card, let's say your limit is, I don't know, $1,000, right? You swipe your card for $900. Well, you're completely over 30%. You're at a 90% utilization. And that's going to get reported to the bureau. So what's going to happen is your credit score is going to go down for that month. If you pay that card completely off by the next reporting cycle, so you have to find out your reporting cycle on your cards, it'll go back down to 0. So you went from 90% utilization to 0% in a 1 month span.
So let's educate the people to not even do that. Keep it less than 30. Keep it off your credit at all. Cash is really king, right? And if I know I understand the education part, but let's not even we don't even want them doing that. Keep it less than,
that's for the most credit. That's for the responsible credit people. But
that's what I'm saying. But like Bruce just said, we're talking responsible credit people who know how it works. If we know, like I said, this is financial literacy, and we're trying to get people to the point. Understand? I don't ever want somebody to have $1,000 limit and go swipe for $900. That is a problem.
But let me say this, Dewana, and this leads to credit manipulation. And you talk about utilization. So let's use the example of people want to buy houses. We know that's the main thing. People want to get their credit where they want to get in a position to buy a house. So if you say, let's use $1,000 credit card and you got $900 outstanding, so you 90% utilized. If you know you're going to go to the table to get a mortgage, you want to pay that off because credit is just a moment in time. So when they pull that, they see 0. Now that you got your house and you need to furnish, you can go ahead and use that credit card again. You know, and that's just a manipulation. But if you not responsible enough to pay that down, then you can't play them strategies because ultimately
it's the same thing when we talked about calling and increasing my limit. Like again, I think that's a conversation more for, like Bruce said, the financial people who really understand it, because you don't want to get, because honestly you got to know when your grace period is. There's a lot of things you have to know. You have to actually know the difference between all your APRs, right? Like I personally know I've had clients that have frequently take out cash advances on the credit card. And I'm like, no, that's like those instant loans when it's like 800%. Don't do that. Yeah. But again, if you have to, like even at 18, come on, we all turned 18. You had 15 credit card offers in your mailbox. Like, again, we know credit manipulation is real. So again, like you people really need to understand that, because as a young kid, I'm gonna give y'all a quick lesson here. So I've been very fortunate to have great credit my whole life. And the reason I have that, my parents, when I was 16, for the credit card. We have a family credit card. My parents didn't tell me until I was 22 years old.
Whoa, we jump into the next topic.
I'm just giving you. So I didn't know that. But let me tell you, when I went to college, right, and I'm in the bursar's office. I was fortunate enough to go to school for free. They said, "Oh, you have an $800 like limit." I'm like, "What does that mean?" They was like, "You $800 to buy." I'm like, "To buy what?" Again, I had a credit, but I didn't have a credit card. So they was like, "Oh," so I went into the school store and I spent $800. Oh, I bought everything they had in the school store. And then I got a phone call from a woman named Denise Mosley. And she said, "What is this charge on you?" Because again, I went to school for free. "What is this bill I just got at the house saying you owe $800? I said, "No, they told me I had $800. My mom said, "You don't have anything. I need you to go take all that stuff." And I did. I had to take all the stuff I just bought back. I said, my mom said I can't have it. But again, that was like my first, again, when people don't understand, all you just told me is I have an unlimited amount and there's some stuff I've been wanting that I could go get. And again, if you don't have that understanding, and like Bruce said, that knowing how to play the game, that can be real risky. And honestly, that's where a lot of us, and I'm saying us, we get caught up because we get those $500 credit cards in the mail and the minimum payments are only $25. We all know people whose credit has become completely jacked up on $25 a month minimum payments because they don't understand it.
So that's more or less the reason why I wanted to bring it up, because I feel like we don't know enough about credit manipulation, how credit works. Like generally people think if I pay the minimum, I'm good. Yes, that's going to stabilize. So you're not missing a payment, but that's not improving your credit worthiness. That's not making you look like the most attractive lender. Now, if you know how to handle mass amounts of debt and pay it completely off, you, my friend, are utilizing credit like a business person. You're leveraging the debt. You're not having it tied to your name. And that's really the difference between, you know, your big businesses, or not businesses, but I mean, businesses do it, right? But your credit-minded people. So how do we push the envelope forward and move our community into knowing how to utilize that credit, and not just the simple tips and tricks? Because when we talk about somebody increasing their credit line, right, from, let's say it was 1,000 and then they get an increase to 1,500. Well, if they had $500 already on the card and the card limit was 1,000, they're at 50% utilization. But if it increases to 1,500, their utilization just went down to 25% or 33%. You know, so now you're towing that line between 30% credit utilization. The kicker is you got to pay it off. And we have to get comfortable with discussing that, because I know so many people right now to this day that don't have a credit card and they're afraid to get one. They're just like, "No, I heard too many bad stories. I don't want it."
Well, first thing is just pay your bills. First things first, is just pay your bills.
This is more of that's more of a budgeting, because honestly, you need to know how to manage money. Like we see it every day. These celebrities, 100 million, 200 million, and file for bankruptcy. And we all know somebody who's probably making $30,000 a year and living comfortably. It's about money management. So that's why I'm saying, like, the cash is really king. It's about how you manage money. We tend to live a lot higher than our means. And again, like I said, that goes back to understanding I qualified for a loan based off $50,000, but you're not paying your bills based off $50,000. You're paying your bills, like Bruce said, they're factoring, so you're paying your bills off $30,000. That's a huge difference. So honestly, money management is more important, because again, like even with the example you have, if you don't have the $900 to swipe it, you probably shouldn't be swiping it. Like you can't afford it. That's borrowed money. You can't afford it. You have to swipe it.
We also got to teach this, that the piggyback off that 50,000 example. Even if you qualify for a $50,000 loan, why would you don't want to spend every free dollar on that loan? Then what else do you have to give up? What's the opportunity cost for taking that money? You can afford it, but you might really can't afford it in the long run, because you can save. If one thing happened, one thing go wrong, now you live in check to check. So, you know, even if you can afford the loan on paper, can you really afford it too? You know, that's still something else to think about. You know, and what I want to teach, what I think we should teach is, I think if we're using credit, if we're inquiring for credit, we should be using credit to make us money, the credit, if we want to start a business, we know whatever we swipe and we're going to have merchandise to sell. And if you're just using credit for normal day-to-day stuff, you should be able to pay that. You should have the means to pay that right off,
Right. And like even like this whole, you look at the whole situation with this pandemic and again, a lack of being financially stable is what made this really, really complicated for a lot of Americans. I think statistics show less than 25% of Americans have more than $10,000 saved. That's like 2-3 months worth of bills. That's not a lot of money, right? So when we talk about that, you have to really understand where people are financially. The wage gap contributes to that. You have a lot of people that are underpaid. You have a lot of people that have a lot more responsibilities. But again, a lot of it goes back to us overspending. Of course, lenders are in the habit of making money. So I'm going to tell you, yes, you qualify for this $500,000 house. Do you need a $500,000 house? Probably not. Like I said, I'm very fortunate to have great credit. I applied for my first mortgage date. The eyes lit up. Nope, I want that house right there. That costs that little bit of, you can get, I know I can get this, but I want that house right there. So God forbid, if something ever happened and I was to lose a job or lose my ability to income, I can still manage my bills. And I feel like that's what happens a lot for us, is we tend to live above our means at times, and we tend to spend money we really don't have. And then to me, I feel like you always should plan for the inevitable, because 2020 was the inevitable. Let's call it a spade here. When reality hits as hard as it did, if you are properly managing your money and living within your means, like, it wouldn't have had such a greater impact. The reality is you have some people like, I can't lose my job, right? I have to go to work. Even if I'm scared, I don't want to send my kids back to school. Even if I don't want to do this, I don't have a choice, because who's going to pay these bills? So I think, like I said, and that's why I said that the credit conversation can be dangerous if people don't have a good understanding of just money management, period.
So I think it's an excellent point you just made. We're not even going to get into 401ks because that's going to be a separate podcast. Tune in. But when you talk about having a savings, my general rule of thumb is, at a minimum, I'm going to have about 4 to 6 months. Now, everybody has their different cushions, but that's my minimum. 4 to 6 months, I know I can cover my bills if all else fails, right? What do you advise people when you tell them how much their cushion should be? And this is the boost.
Go ahead.
6 to 12 months, and the reason that is, the more you have, the more time you have. If I get fired today, I don't have to take the first available job that I find because I have bills due tomorrow. Like I would say 6 to 12 months, because what that does is, again, that provides a certain level of ease in your mind. Like, I'm not stressing myself, like trying to kill myself to try to find something. I know I have 6 months, right? I know I'm okay. I know we can manage this. And honestly, you should even have some outside of that. But I usually recommend a minimum of 6 months. Try to get a year, because again, that's a year where I don't have, like, we're still in this pandemic, right? Like, we're still in this pandemic a whole year later, right? And like I said, if you were one of those people who do properly manage your money, I'm not really maybe too stressed. But like I said, and don't get me wrong, there's a lot of factors that I'm not going to downplay that contribute to where some people are financially. So I don't want to excuse that or act like that's not a big deal. We all have situations that may have contributed to where we are. But again, do what you can. Like I said, start somewhere. If it's $25 a month, $50 a month, you know what I'm saying? Like I said, it goes back to accountability, being willing to make necessary sacrifices, cut cable off, don't go to the gold room, for 2 months, like whatever. Like, like I said, it's really about what you say you want to do. Like, whatever goal you say you want to accomplish, are you really willing to put that time in?
And sacrifice.
I better not catch you at the bonnets. Hey, so you guys made good points. I kind of want to speed it up and transition into debt consolidation. And what is your overall outlook on debt consolidation? Because I could go all day and talk about pros and cons of consolidating that debt, or just learning how to loan stack and pay off those higher interests or higher monetary value loans. So what is you guys' opinion?
One thing about me is I don't pay credit card interest. I'll never pay credit card interest again in my life ever.
There we go. There we
Because
go.
I'm so credit worthy that everybody's begging me to take their card. So I have a few apartments, and if I need to do a project, I just self finance. I can just go get another credit card. I can give me a 0% interest for 18 months, 24 months. Look for the best promotion they have, and I can do what I got to do. Or I can get a new card. I can get a new balance transfer, and when my promo was up, I could swing that over there. So I'm saving thousands a year on interest. I may pay a 3% transfer fee, but I'm saving thousands on interest, and I'm self financing
as opposed to
myself.
22-25%. So
Yeah.
like Bruce been saying the whole time, it's just really understanding the game. I've had a client who transferred the same balance like 3 different times and paid interest in 5 years on a credit card. Guess what? Oh, you giving me 18 months? Yeah, I transferred this. Oh, you give I transferred over there.
Yeah.
You really just got to know how the game works.
Know the game.
It's funny you guys mentioned that, because when I was talking about that credit manipulation and almost maxing a card out versus paying the card off, I guess the caveat to that would be I haven't paid interest on a credit card in, I don't know, maybe 5 years, 5 or 6 years, because even though I might have a high utilization, I pay it off before the cycle hits for the interest to start compounding. I'm not going to leave it on the card past 30 days. That's
what I mean. Like, that manipulation works both ways.
Yeah. It does. If you know the game, you make it work.
The rules to benefit you.
Yeah.
Like I said, I'm gonna keep transferring this balance until I pay it off.
Yeah.
And like Bruce said again, this is a buyer's market. Like that whole saying, the customer's always right. It's very, very true. Like, you need me. They don't make money if they don't have people to lend to.
Exactly.
Point blank, period. No company is making money if they don't have customers. You need me. Like, honestly, like, even especially in this pandemic, buyer's market. You can walk up to a dealership. Y'all ain't sold a car in months. I'm not putting nothing down. And I want a full tank of gas. Like, it's a buyer's market. Like, you can kind of come. I mean, houses. The interest rates people are getting for houses.
Yeah.
Like, again, companies are strapped. You gotta need me more than I need you. And you want to play that to your advantage. Clean and detail the whole car. I want some floor mats as well. Fill a tank up.
Yeah.
I can do all of that.
Or I go across the street because they gonna do it.
Exactly. They gonna do it.
I would be remiss if I don't have a discussion for all the people with college loans, right? So should college students refinance their loans from a federal lender to a personal loan for a lower interest rate? What are your thoughts on that?
I don't have no thoughts on that. I'll let Dewana handle that one.
Wow. I think there's benefits to both. For a prime example, we're in the middle of having a conversation with student loan forgiveness, which that would happen to federal student loans. So if you have private loans, you probably sucking your teeth and piss right now. However, also personal loans have advantages where the interest rates are lower. So again, that's one of those things where it depends on your situation. It depends on what you qualify for. And again, when we talk about credit manipulation, there are a lot of things that contribute to why people of color may not mostly have private loans. That's a whole nother conversation. But like I said, there's perks to both. There are perks to both. But again, when we talk about just building financial wealth and independence, like I said, for me, you really want to try to pay for cash for anything. I'm a firm believer, if you don't have a full scholarship to go to school, you should be at someone's community college. College is ridiculously expensive nowadays, and on the back end, the market is not the same. You can go to school and pay $150,000, $200,000, and you come out of college and make $30,000 a year. Those two things don't add up. I'm a firm believer. If you don't have a full ride to school, you should be going to a community college. Because guess what? I don't care where you get your degree from. It won't say that you went to Delaware County for 2 years. It's going to say Widener. It's going to say Temple. It's going to say wherever you graduated from. Save yourself a couple dollars, right? And I guess maybe some embarrassment. Some people feel like, I guess it's less of them to go to a community college. But again, college has become drastically too expensive. And the job market and the pay wage is nowhere near it, which is why you honestly have a lot more entrepreneurs coming up nowadays. So you have a lot more younger people starting business, because I'm gonna go to school Like that's where people are. I'm making 30,000, but Sally Mae want 800 a month. That don't make sense. You have student loans that are higher than rent.
So, and this is just my little take on college loans. If you ain't got to, don't do it. Don't switch into a personal loan. That's me personally. Now, I can give you some tips and tricks on what to do to make the personal loan attractive. But personally, you don't get forgiveness. Another thing you don't get if you switch to a personal loan is amid this pandemic we had, everybody that has a federal loan right now with Fannie Mae or Freddie Sue, Fannie Mac, Fed Loan Service, any one of those names, right now, you are paying a 0% interest. So that means if you had financial hard times, you don't even have to pay on it because it's at 0% interest. Or you can pay on it, don't worry about the interest, and stack that principal down super fast. You don't have that option with personal loans. Now, if I'm going to give you the credit advice that I would suggest, one, I would say, hey, look at your federal loan, because most people have anywhere between a $35,000 to $100,000 student loan debt. What you should do is pull that loan up, because typically when you look at that federal loan, it's not one big loan. It's a bunch of loans. It's like 6 to 12 loans, and all of them have varying interest rates. What I would do is I would call, right, and get my monthly payment down to whatever I can afford. That's for starters, right? Or at least what they think you can afford. Because they don't know. They might look at your bank stubs, but they don't know what you actually have to pay. And that's when we talk about gross versus net, right? But for starters, get it down to what you can afford. Then you look at the different interest rates. I personally, after I make that minimum payment, I'm going to hit those high interest rate loans first. That's without being said. If it's a 12% on there, I'm not leaving that on there.
You have the snowball effect, which is
Exactly.
real common, as far as you want to pay the minimums on all, and then find your one target debt that you want to focus on. Usually, like you said, your high interest, and I'm putting all the extra money I have towards that. And once that's paid off, all that money I was just paying, you're going to apply it to something else. And you're just talking about saving years and thousands, tens, even it depending on your situation, hundreds of $1,000s in interest over the course of your lifetime. So again, all of this just really goes back to financial literacy. That's one of the reasons why I like my job, is I get to teach that to high school students, 14, 15, 16-year-olds. I was very fortunate to have the financial savvy parents I had and have the education I did, but the reality is most people don't. Most people are in their 30s and 40s struggling because of stuff that happened when they were 18 and 19. Those $500 credit cards where I maxed them and the minimum was only $25 a month, and I didn't even know what to do, and I didn't pay them. Like, you really have people who are, like you said, just student loans. I went to college to try to better myself, to put myself in a better opportunity, and now I can't advance. I can't get a house. I can't better myself because I decided to better myself. Like, that's weird. So again, it really just goes back to that financial literacy of understanding really how money works, how debt and credit works, and then, like I said, from there, try to make better decisions.
So, hey, Bruce, so when we move to this next section, I want you to take it first. Building for the future. How can we as parents, and Dewana alluded to it earlier, she jumped straight to the next topic. I said, pump the brakes, right? So how can we build for the future in terms of credit and just overall wealth for our family through credit manipulation for our children?
I think it first start with teach them the value of money and living within your means. That's first and foremost. Always paying your bills on time, not biting off more than you can chew. And like Dewana had, she was made an authorized user at a young age. She had developed credit early. She didn't even know she had credit, and that was something her parents knew to do to build her for the future. So we can do things of that nature, but it really just start with having the conversation. A lot of us don't know the value of money. We don't know what credit is. We don't know how it affect us. Like you said, at 18, going to college, getting all those card offers in the mail. We don't know how that's going to affect us when we're in our 30s, when we're ready to buy that house, when we want to, move forward and with our life. and we're still being haunted by mistakes of the past just because we wasn't illiterate on that topic. So it just start with the conversation that we're having. And like with my company, I would much rather you fix your credit on your own. I would much rather give you a tip and you do your own letters and things of that nature, so you could teach it to your kids and the people in your family. I much rather not take your money and do it. I much rather you do it on your own. That way, you can reciprocate it through generations.
For sure.
Just like you already said, and I did allude to it earlier. But that was just one of the best, and more importantly, I didn't even know. When I went to go buy my first house and I found out what my credit score was, I was like, "What?" But again, that's because at 20, I think I was 24, I had 9 years of credit history. At 24. That doesn't happen. That does not happen. But again, that was because of something my parents did. So, like I said, that's the best way to help kids is to, first and foremost, make sure your credit's good, though. Let's start there. Do not add your child as an authorized signer if your credit's not good, because now those missed payments, that goes on your child credit. Don't ever allow people to put stuff in your name. I know that might seem like that's the first thing we talk about in my class. Don't ever let someone there's a reason you don't qualify. And that's the thing, that goes back to us wanting what we can't have, right? There's a reason you don't qualify, whether it's because you don't have any credit history, but definitely, and another way for younger kids when you turn 18, 2 ways, you can get their phone switched into their name. That's a manageable bill as far as the amount that you're paying, and also secure credit cards. Those secure credit cards work just like debit cards at first. So basically, you have to put up the money, and that's your limit. Let's say you put up $500. So it works exactly like a debit card. You swipe it, you pay it, and they still report it on your credit report. As you deem that you're trustworthy, it'll kind of then switch over to a traditional credit card. So that's a really good way for younger people to build credit, because again, I can't even swipe it because it's acting like a debit card. I can't even swipe it if there's no money there, because it's the same way as your debit card. So authorized signer, secure credit card, and then if you are going to put something in their name, I would say something small like a cell phone, just because it does get reported to the credit bureaus. And like I said, the monthly amount is usually something small that they couldn't manage if they're just working like their own jobs or something like
that. I wish they had this game when I was a child, but Robert Kiyosaki changed my life, right? A lot of people reference him. I follow all the major financial guys. You got Robert Kiyosaki, Grant Sabatier, Grant Cardone, all these people out here telling you how to invest your money. But obviously, you got to do the research yourself. But as a parent, if you can get Robert Kiyosaki's game into the hands of your child at a young age, it's called, I think it's called Cash Flow, How to Get Out of the Rat Race. That game is game changing for anybody that needs to learn how the investor thinks about credit. It's mind boggling how he was able to compact so much stuff into one game. Now, granted, there's things that ain't going to be covered, right? You're not going to talk about equity in a house. You're not going to talk about cash, the different types of cash flow or how you can manipulate it. But for a fundamental level, that game changes mindsets. So if there's anything you're going to take from me, it's go out, look for that game, and learn how to play it.
I will also say, sorry, just to cut you, just a little footnote. Monopoly and the Game of Life. We actually play that in my personal finance class. Like, we have a couple times throughout the trimester where we just play, and it's so funny. And like I said, I'm being from Chester. You know a lot of the parents of the students, and it's so funny how reality hits them, especially in the Game of Life. It's one of my favorite games to play because it's kind of like, oh, I want that real big house, and then they start looking at the little $30,000 that they have over there. I can't afford it. What you gonna do? You want some more loans? They're like, nah, I don't want that. But it's just a funny way to even just get their minds churning about how things actually work, and to start to see them like, oh, that's crazy, right? So stop asking your parents for $5 and $10 all the time. You see and one of the things we actually work on is a budget where they don't have to give me the amount, but when we're learning about budgeting, have their parents list all the household expenses. And my mom spent a lot of money. Yes, she does. Like, stop asking for $20 every other day. Like, you're starting to have that reality of what the expenses. So I think the Monopoly and the game of life are two fun ways for kids to even just start a conversation around financial literacy.
That is an excellent point. That's honestly why I love cash flow so much, because it's almost like it combines Monopoly and life together. Mm-hmm. And you actually have to fill out an expense ledger. Like, you got a whole expense report. You got to go through your ledger. And if you mess up a number, you just messed up your life.
So no, I definitely think the earlier, and they actually have a lot of games, like card games, where you could teach your kids financial definitions. I think the earlier you expose kids, I think that's with anything, right? The earlier you expose children to something positive, it will have a rippling effect. And like I said, that's why I like, teaching the subject I do to 14-year-olds, right? Because now you're already going to know when you turn 18, even some of our students that graduate, they'll come back and say, nah, I remember Mosley, you said this. I'm not doing that, right? But it's like, now you have an understanding instead of kind of getting caught up in that loop. Because again, the lenders are not on your side. They're there to make money. And that's off anybody, right? So you have to understand they don't have your best interest at heart. They're going to try to get you the highest interest rate, the highest payment. Because guess what? Even if your car gets repossessed, they made money off you for the few months you did make it. They're going to resell it to somebody else, and they're still going to make money, right? So you have to understand that they don't have your best interest at heart. So you really have to have a good financial understanding and education when it comes to how to better your finances.
Let's at this time transition and try and take some questions from the audience. We're coming up on the close, so I want to try and get the audience engaged. Do we have any questions out there from the audience? Let's see. Kenneth, let's see. We got Kenneth Covert, and this can go to either one of you. It says, what do y'all think about the credit app that Jay-Z is supposed to roll out where things like Netflix, Hulu count helps your credit?
That one might be a little dangerous because I personally don't know most people that pay their own Netflix or their Hulu account. I feel like most of us use somebody else. Yeah, I know most of us use somebody else's, so that might help that one person, but it won't help the masses. But I mean, I think, again, like I said, any little bit helps. Like Bruce said from the beginning, it goes back to just accountability and making sacrifices when we talk about, even something like that. Like I've had clients who have Apple Music, Netflix, Hulu, Spotify. That's up to $50 a month that quick. You know what I'm saying? So it's about making sacrifices. I might have to cut that stuff off for 6 months to pay. You know what I'm saying? Like it's really just about sacrifices. And honestly, if you're saying this is what you want to accomplish, like really making the necessary moves to do it. And that's with anything. That's with anything. You're trying to get in shape. I'm trying to, whatever you're trying to do, is I have to make the necessary sacrifices. And it's usually not a forever thing. It's for a specific period of time. You just really got to be willing to, buckle down for that 6 months, that 12 months, or whatever you need to do.
And it'll be easy if you really want it.
Yeah,
for sure. We got one more question out here that I seen. It's from Mark Freeman Sr. And Mark said, does paying off installment loans faster boost your credit score?
Oh yeah, I think because for one, just paying your loans on time, you're getting credit every month for making that for payment history. But I don't know. Do it, Dewana?
Well, first and foremost, you got to make sure some lenders have prepayment penalties. So that's one thing people should know. Some loans have, if you pay, which is the weirdest thing. We know why, because the earlier you pay it off, the less money they make, right? So some loans have prepayment penalties. So that's one thing you should always ask before applying for a loan. For me personally, I'm going to say I don't know, because I've never really heard of it. But again, you paying anything off early saves you a lot of money. Yeah, and again, like you said, if you're paying extra, like Bruce said, if you're paying extra, you're definitely paying it on time, which means that's just being reported positively on your credit score. And then, like I said, if you do pay something off, the less, like, loans are based on your debt to income ratio. So the less debt you have, the more you would qualify for somewhere else if you were to apply for something else.
So I can't give you the most concrete answer, but I'll give you my experience when it comes off paying off installment loans. I've paid off 2 cars, and after I paid off those cars, my credit score went up by 1 single point. 1 point. So does it go up? Sure, I guess, but 1 point ain't enough to make you or break you.
Yeah.
It go down. Sometimes you'll pay something off and your credit score go, like, it's really such a numbers game. It's such a timing game. Like I said, knowing when your lenders report to the credit bureaus, right? Because I know some people that, I'm gonna pay it, and let's say you paid the bill, and you like, well, my credit score didn't change. Well, they already reported before you made the payment. So it's really just a numbers game. Like, you have to know the rules and act accordingly, in a sense.
Now, one suggestion I would make is, once you pay off that installment loan, all that money that you was paying towards that installment loan, you take every single dime and pay it to the next installment loan. Yeah. Because once you start doing that, now you're getting into the credit game. Now you're getting into how to actually manipulate, 1, your overall cash flow, and then 2, the credit manipulation. Because if you can start paying down those installment loans faster, you can start utilizing revolving credit like a business person. And you can start leveraging things beyond any means because you have a certain amount of cash flow. The goal, like Ms. Mosley said, though, is to get off of credit in general. You want to get to the point where you don't even need it, but you can use it if you want. And this is why business people use credit, because they rather use other people's money than their own. So I'm gonna keep my money in the bank and let it keep averaging this 4% yield, or 0.5 if it's in a money market account or whatever type of account I got open, right? While I use somebody else's money, and let's say I took out a loan and it was for 7% interest, right? But that interest don't start incurring until 3 months. Well, in my mind, that means I got 3 months to pay it off, right? Because I'm not paying nobody interest. I refuse. But they don't know that. They think, all right, we're going to get them.
I'm going to say one more thing, and I got to go because I'm supposed to be off here at 7. But I will say, if you are going to do any, like when we talk about thinking how business people think, if you are going to do any type of debt, I would recommend lines of credit. And the only reason, usually through your bank, I would probably tell people to bank more with credit unions just because they're a little bit more community lender friendly. But if you're going to have any type of debt, I would recommend a line of credit. For one, the interest rates are more than half less than any credit card that you would probably have. And also, there's no set maturity date. So the payments are always a lot less. Again, that is probably, for me, and that's just my personal opinion, the best form of debt. You have to be careful because line of credits are usually attached right to your bank account, which means, hey, just go ahead and transfer that money into my bank account. If you don't have good money management skills, that can hurt you. But again, it's still a debt. But as far as interest rates are concerned, it's a lot more affordable than any other payment. But I do got to log out. I have basketball practice. I do appreciate, Bruce. It was excellent talking with you. I appreciate both of y'all having me on here. If we do it again, definitely let me know. But I
appreciate it.
All right.
Bruce, have a good night.
Bruce,
good night, Juana.
Final question for you before we log out. You ready for it?
I'm ready.
All right, here we go. Do you think our community's willingness or lack thereof to talk about finances inevitably affects our ability to thrive financially?
Without a doubt. Because if we're not talking about it, how can we even thrive in it? How can we even be educated on it? So we have to talk about it, from a kid, from with our kids as young. The importance of money, the importance of credit, the importance of keeping your name clean, and the importance of coming together. I think we need to really start, in addition to building our credit, we got to start pooling our money together. Everybody talk about buying back the hood and buying black. We got to learn how to leverage credit in a good way. And the last thing I say is, we talked about a lot of people want to become entrepreneurs now with the pandemic and everything. and try to learn about business credit, it all starts with your personal credit. So you got to keep your name clean just to even establish business credit as well.
All right, Bruce, we're about to bring this thing to a head. Go ahead and let people know about your credit solutions company one more time, and let people know where they can find you.
Hey man, I'm Bruce Collins, the owner of Broadway Credit Solutions. You can find me at BroadwayCreditSolutions.com. Email me at BroadwayCreditSolutions@gmail. You can find me on Instagram at MasterBruce18 or Broadway Credit Solutions. I'm very easily accessible. I'm a wealth of knowledge when it comes to credit in the financial industry that I'm willing to give to whoever want it, because I want to see everybody better themselves. That's pretty much it.
Thank you, Bruce. Thank you for coming out. So
No
you had it
problem.
here, folks. This is Chestorian podcast. You heard it first with financial literacy. If you need anything, whether it be financial needs, whether you want to take back the block, if you want to talk about the current situations and things that's going on in the city of Chester, please reach out to the Chestorians. If we don't have the answer, we know somebody that does. So again, you can find me on Instagram at CPT. That's Big C, Big P, Big T that always got the financial literacy _ Young Inspires. Holla at you.
All my life, been grinding all my life. Sacrifice, hustle, pay the price. Want a slice, got to roll the dice. That's why all my life, I've been grinding all my life. All my life, been grinding all my life. Sacrifice.